Welcome to Farm Here Daily, a Field Forward podcast. I'm your host, David Geiger. Today on Farm Here Daily, should we question expectations of poor early yields? Reese Drenth of the Ground Level Dispatch talks about that, as well as some of the impacts from the recent WASDE report. Please be sure to like and follow the podcast, as well as our social media at Field Forward Pod. We would love to have you join our community, keeping folks informed about what is affecting our farmers. This is Farm Here Daily. And joining me on Farm Here Daily, we are going to go over the markets with Reese Drenth with the Ground Level Dispatch. And Reese has been on the program quite a bit over the last few weeks, and always glad to talk to him about what's going on in the marketplace. Reese, as a reminder for folks who aren't familiar with the Ground Level Dispatch, it is a twice-a-day market update, giving farmers essential information that they need on grain as well as input costs. And it also helps them make smart marketing decisions. You guys do that. And also, you have a deal with us where if you go to the link below in the description, you can try a month free trial for the Ground Level Dispatch. Reese Drenth with us right now. Thank you so much for your time. And since I have you, let's go over that report we had last Friday and that WASDE, World Agricultural Supply and Demand Estimates report. How is that different this September? How has it changed from August? And what are your general thoughts about it?
Yeah, thanks for having us. Always a pleasure. So we did get an updated S&D or WASDE from USDA last Friday. The report itself didn't have very many structural changes. The market was expecting lower corn yields, slightly lower bean yields, and it did get that. The market reaction, however, on last Friday was very positive. Just for the record, I guess, corn closed up 10 cents a bushel post-report, and soybeans, they closed up 13 cents post-report. So, even without a lot of structural changes in the S&D data, the markets were higher. Why is that? In our opinion, the grain markets over the last 7 days, really, and the grain markets moving forward here are all a function of yield reports. So, the market got what it wanted. The market got what it expected it was going to get out of the WASDE report and went straight to trading yield. And the early yield numbers have not been very good. I think this year it's safe to say that the difference between fungicide and no fungicide, might be anywhere from 20 to 40 bushel the acre on corn. And a lot of the early stuff that's going that has had disease pressure and that's killed the crop because fungicide wasn't applied, or maybe even earlier numbers that are going, they just have not gotten the yields that we saw last year. It's super variable. And so the market's grabbing a hold of that. And kind of chopping around steady to higher, in this post-report era here. I'll also add that from the looks of it, we've got a very hot and dry forecast coming up in the next 8 to 14 days. That's important too. We learned last year that a very hot and dry forecast can really take the moisture content out of corn and beans like crazy. And subsequently, less moisture means less weight and less yield per bushel. We know last year USDA yield estimates went down significantly because of basically that in itself. It kind of came out of nowhere last year and then, ended up being pretty supportive of the marketplace. I think the market feels like that we have risk of that happening again. And so that's also been a short-term positive here post-report. So the original question about the report, nothing burger. We can make arguments as to why a few tweaks USDA made should or should not be made, but they really don't matter that much overall because the ending stocks numbers didn't change that much. And at the end of the day, the ending stocks numbers are really all that the trade is evaluating. But again, markets have a grasp on early yield reports, and those have been variable enough to give us some support and then chop as we kind of wait for the meat and potatoes of the harvest season to give us the valuable data that we need.
As a more general question, when we talk about these reports and the response we get from them, you mentioned that pretty instantly higher number in terms of the closing end of that report in terms of what farmers got for bushels. So I wanted to just go over that baked into the market question. How do you determine from your perspective, and then how do farmers then determine how to decide on when the market has generalities baked in versus when they are surprised and we'll see, the price go up?
Yeah, that's a good question. It's important to remember when you think about what's baked in or not. They're called futures markets for a reason, right? So like ever since the August WASDE report where the national core deal was 188 bushels the acre, a massive, massive record. Corn's traded higher, right? If you look at a corn chart, we traded lower the day and a half after the August WASDE report, and it's been nothing but up since. Okay, that's the market baking in a lower yield number. Another way to say that would be nobody believed 188 was doable. That is a super, super high corn yield number. So from there, it just becomes a swag. You know what I mean? Some traders are going to tell you that they think 180 is possible. Some think 189 is possible. Some think we're right in the middle somewhere, 183, 184. Oftentimes you'll hear people say, it feels like we're trading this number. It feels like we're trading this number. And so, looking at charts to kind of prove that point, charts are great. They're a great indicator of what you should have done, right? But like you can think about, the number, the trade baked in over the summer from a yield perspective was huge, right? Because we went straight down. And then post WASDE report in August, the number we're baking in is obviously higher than the number the USDA gave us for a plethora of reasons. So that's a good question. But again, like when the futures market gets a bit of information, its job is to discount that information and figure out, okay, what does that mean for the price of corn tomorrow, the next day, the next month, the next year? It's always looking ahead and discounting the information it has today. And that baking in process, again, if you look at a chart, you can see that happen over time. And again, what happened last Friday, it got the number it expected straight to, it doesn't have to discount anything at that point. It's already discounted it. Okay. Straight to what are yields doing out there? The early stuff's kind of bad. So we're going to rally.
This is Farm Here Daily. We will continue our conversation in just a moment, but first, let's take a look at the marketplace. And there was a negative trade in grains at the close on Thursday. December corn down 3 cents, 4.23 3/4. March a decrease of 3 cents as well, 4.41 1/2. Soybeans in November 6 1/4 down at 10.37 1/2, with January falling 6 1/2 cents at 10.56 1/2. Soybean meal in October 90 cents a ton in the red, $283 even. Soybean oil in October 2/3 of a penny lower at 50.57 a pound. December wheat 4 cents down, 5.24 1/4, with March a decrease of 3 3/4 at 5.42 1/2. Hard red winter wheat in December 6 1/4 lower at $5.10, with March a decrease of 5 1/2 cents at 5.31 3/4. In the livestock market close for Thursday, green on the board there. October live cattle up $1.27 a hundredweight, $232.37. December rising $1.47 at $234.15. Feeder cattle in October, $2.60 a hundredweight higher, $351.72, with November rising $3.10 at $347.22. Lean hogs in October, 15 cents a hundredweight more at $97.47 a hundredweight, with December an increase of a nickel at $87.70 a hundredweight. That is the Thursday market close. This is Farm Here Daily. Let's swap more to the demand side of the question, and that is, obviously, we have China. Talked a lot about China over the last month or two when it comes to how much beans they are buying, but also we have the start of Brazil's planting season here very, very soon, if not already rolling out in some parts of the country. What are some of the demand expectations and supply expectations from our competitors and our buyers?
Yeah, it's a great question. So, you can't get away anymore these days without talking about Brazil. Obviously, they're our number one competition, and their planting season is not going full gas yet. It's a huge, huge country. They are going in some places, but it's important, and there's those soil conditions down there that they have some rain to work with at the beginning of at the beginning of planting season. And it does appear like it's forecasted, at least, that they're going to get it. That is a very bearish input, particularly with beans and corn too, but particularly with beans. That if you get if you don't have conditions where the Brazil crop under much more marginal soil conditions versus the U.S., if you don't have the conditions to get them off to a bad start, okay, that assumes they get a good start. And there's a ton of acres, and then just becomes this weight that you can feel on the U.S. corn marketplace and bean marketplace when they get off to the right foot. Obviously, we know that they're dominating the global soybean export trade. We know that they are not dominating the U.S. or the global corn trade yet, but they do have the stocks from a record corn crop, to do that whenever they decide to sell corn. So that's also a big risk. So like when you factor in the export success that they've had, the export success that they could have, and then they're already on another planting season, it's getting off on a good foot. That's not great, right? And specifically, it's not great when we are arguably now, but we would argue less arguably, dealing with a massive corn and bean crop here in the U.S. also. So we want it to be hot and dry to start the planting season. And, we like it to be hot and dry at the beginning of planting season, and then our crops to get a nice rain on them. They need that initial moisture. We want it to be hot and dry. We want them to struggle as much as possible, because that's going to help, our chances of selling our grains for a better price. So far, so good. And that's, probably why we're seeing a little bit. I mean, that's another negative input, I guess, on prices for the week.
To kind of wrap things up, going back to the domestic front, harvest is rolling out. What are the number one things you guys are watching for as we start to get more information from this year's harvest?
It's a great question. So right now the story is early yields are bad. I keep referring it to the meat and potatoes of corn and bean harvest in this country going to be as bad. We don't know the answer. In our opinion, I think markets overreact, and I think that it won't be as bad as what we think, or as what maybe the market's trying to price in here. We'll see, right? I'm not the soothsayer when it comes to what the national corn yield and soybean yield is going to be, right? But in my opinion, I think it's going to be better than what some of the hype has been early on here. I think it's important to remember when we look at the hot and dry forecast coming our way, we saw very, very similar conditions last fall, right? Our corn yield nationally went from 182, 183 down to 179. It pretty much all had to do with loss of moisture that negatively impacted our yield estimates. Okay. Nothing about the way really corn futures or corn cash markets along the river system in West Texas, in California, in Iowa, in Nebraska, nothing about cash or futures markets last year says that yield slipped that much last year. Okay, so like that 182 to 179 or 183 to 179 last year, it was great when we got it. We got that import corn rallied, gave us guys a chance to sell some okay cash numbers in early winter. But as the year progressed, right, and USDA is out there saying that we have a pipeline minimum corn ending stocks number last year, 24-25. There was never any panic. The ethanol plant got the corn that they needed. The feed mill got the corn that they needed. The river system, the export system, even under massive record exports, got the corn that they needed. Nothing about how the actual cash market traded suggests that the corn wasn't there. So our tinfoil hat theory is that this rapid dry down, right? Risk is not as big as what we think it is. Because last year, the corn was there, even though it dried down. And it may not say that on paper in the USDA balance sheet, but the cash markets told us that. And so the point is that even though, and last year we didn't fight disease pressures as hard as we're fighting disease pressure this year. Okay. So like that's a different factor. And we recognize that. I guess what we're saying is be conscious of how much you wrap in to this bullish story that we have now, that the crop's not there and it's going to get hot and dry. It's going to get even worse. Because again, from what we see out of the cash market, there's still old crop corn moving. I was driving through northern Indiana yesterday, and I saw trucks coming out of an old bin site, clearly loading old crop corn. It was not fresh corn that had just been hived. They were hauling old crop corn to town, while there's combines running a few miles down the road. There's still old crop corn moving. And that shouldn't be the case if we were as tight as USDA said we were. And again, we were as tight as USDA said we were because, yes, we had good demand, but also our yield apparently took a 4 or 5 bushel hit because of how hot and dry it got. So again, is the story of, oh my gosh, it's getting hot and dry, we're losing yield left and right, valid? To a degree, but probably not the degree that we think it is. So be careful about how caught up we get in this. The disease pressure thing's real, but we would argue that the old crop carryout, so this year's beginning stocks, are 200 to 400 million bushels too low, which means in reality, we're starting out 200 to 400 million bushels higher with beginning stocks than where we actually USDA printed. This is a kind of a tinfoil hat theory, but it's what the cash market told us. So just be mindful of that. And that's really what we're watching. Is the disease pressure, is the hot and dry pressure, is that impacting yield enough to really flip the script and turn this thing around? Because if we are going to yield 181 to 185 nationally, we got plenty of corn. And we really need something bad to happen in Brazil, or we need China to start buying U.S. corn. So that's what we're watching. Might not be a very popular opinion, but I think, again, from a cash market perspective, it's very real.
Well, I appreciate the thoughts. The Ground Level Dispatch is a place you can go to find more information like that. You guys have nice bullet points throughout the week, twice a day, and then also on the weekends you'll have a little bit more of a write-up, maybe once or twice a post per weekend. So you can find a link below in the description to hear from Reese Drenth or John King or the other folks at the Ground Level Dispatch and try out a month free subscription. Reese Drenth is with the Ground Level Dispatch, joining us on Farm Here Daily. Thank you so much, Reese, for your time.
Appreciate it.
This is Farm Here Daily, a field forward podcast. Thank you so much for listening. Again, in order to continue to produce this type of local content, we would love to have you join our community. So please follow the podcast as well as our social media channels at Field Forward Pod. You can also find me on social media at Geiger Reports. Again, I am your host, David Geiger, and I'll be back again tomorrow, everybody.